All right, what is up, traders? What's up, tycoons? Super excited for today's video. Bill Ackman covered his bet against treasuries and has closed his massive short position. Did TLT just bottom? We're going to discuss that in today's video and, of course, break down the TLT chart. We got very close to our wave 5 targets, and as I've mentioned, we could, come down to 82, 80, 78. Overall, it was just a broad range. We were looking for those targets, and TLT did come down to that 82 territory. But we're also going to cover lots of really good information and data in today's video. This is just a quick overview of some of the things that we're going to go into. Stanley Drunken Miller said that central banks, not earnings, move markets. And I kind of agree with that. Okay, about half and half. I think both are pretty important, but the central bank definitely has a big factor in the market these days. All right. We're also going to talk about, prolonged periods of rising interest rates and how, basically the market performs during those. All right. Go over many different things. We've seen pretty much the worst bear market we've ever seen when it comes to bonds and the bond market. We'll talk about that. There's a new ETF that I want to bring to you guys' attention, as well as some other data. And we've got some really crazy data we're going to break down, especially this one right here. Okay, we're going to talk about technology and the possibility of it becoming 50% of the S&P 500 weight in the future. Okay. Now this is not soon. This is going to be, in 2040, 2050. But we'll talk about some of those possibilities. Okay. And then we'll also talk about, some seasonality factors and whether or not we could potentially be bottoming here in October for the end of year rally. And, really break down all of those charts as well as the S&P 500. We'll see if the technical analysis is lining up with any of this. All right, and dive deeper into the TLT chart and go over some of the technicals, why we're seeing a bounce, where we could potentially go up to, as well as take a look at the 10-year Treasury yield. This is pretty much the instrument that everybody pays attention to the most, to take a look at Treasury yields and where yields are going across the bond market. Okay, so as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. I started a completely free newsletter for you guys. It's called Investment Intelligence. Link is in the description to sign up for that. Really good, free, valuable content, as well as free trade ideas, right? And this is what it'll look like. We'll highlight some of the conditions we're looking at, okay? And you can see how this trade played out. This was another one highlighting the conditions of this rising wedge where we thought price could come down to. And you can see that one played out very nicely there as well. All right. And if you're ever interested in, figuring out how we're able to get these really nice returns, trading options, okay, you can always go to my Ko-Fi page. There's a link in the description for that as well. Click on commissions, and there you can book a 30-minute and 1-hour session directly with me. You can also request a YouTube video on the topic of your choice. And, also hit this little buy a coffee button if you enjoy the free, valuable content I put out for you guys. Now, let's talk about things, okay? Bill Ackman, he covered his big short, all right? And as soon as he did, we started to see treasury yields fall, resulting in bonds moving, okay? Now, Bill Ackman is pretty famous for this in moving the market. He did this during COVID. All right, and he started talking about how he was shorting treasuries, and a lot of institutions, okay, not just retail traders, pay attention to what he's saying, okay? And so other institutions, we've talked about in previous videos the massive amount of short positions in treasuries and how there's a very good potential we could see a short squeeze, if all of these massive short positions start covering their short positions. Okay, so we're going to see if that's actually going to happen, if we're actually going to get a huge short squeeze, or if this is a little bit more of a dead cat bounce. Okay. Household savings, okay, if you look compared to the pre-pandemic norm in select advanced economies, the United States has actually less savings. Okay, so the United States has been basically just on a spending rampage, and we're actually seeing that we have less savings now than we did pre-pandemic after all of that stimulus money has dried up. The S&P 500 has done better, though, when rates were increasing. So, a lot of people are saying that, oh, well, treasury yields going higher means the stock market has to collapse. If you take a look, this is the year-to-year change with the 10-year treasury. Okay, the average rolling 1-year performance based on the year-to-year change in the 10-year treasury. And you can see when the 10-year treasury yield is actually rising, okay, the S&P is actually positive. Okay, if you look between 0 and 50 basis points, 50 basis points and 100 basis points, and then greater than 100 basis points, the S&P is actually positive. So just because treasury yields are going higher, it doesn't necessarily mean that stocks have to crash. Remember, oftentimes when it comes down to the basic fundamentals of treasuries, the yields are going to go higher when basically bond investors are seeing growth in the economy. And we've talked about the GDP forecast for next year, looking positive and forecasted for the US GDP to grow. And so because of that, that's been one of the factors why we've actually seen the 10-year treasury yield continue to rise. Now, if the bond market thinks that a recession is coming, okay, and the Fed also thinks a recession is going to come, they're going to cut interest rates, okay, and that's when you're going to start seeing treasury yields start plummeting, is during those recessionary times. So they are a good hedge, bonds and things like TLT for a portfolio right now. The 60/40 portfolio was really got devastated in recent history, and it was pretty much the worst performance for it. But now, these things are kind of attractive again, right? Where, just in case if we do go into a big recession and the Fed has to start dramatically cutting rates, that would result in things like TLT going up, and it's, potentially a good hedge for you guys. Based off of that. Now, the probability of U.S. recession has dropped below 50%. Okay. And this is the probability in the U.S. recession in the next 12 months. And this is from the Wall Street Journal. Okay. This is a survey of economists. And you can see it's actually back down below 50%, where we haven't really been in this area and in this territory over the past year or two. Now, Stanley Druckenmiller said central banks, not earnings, move markets. And basically what they mean is the famous slogan, don't fight the Fed, right? And so, a lot of people have some misconceptions about that. And I think that, a lot of people have been fighting the Fed and really just not paying attention, right? I mean, for a very long time, they've been saying higher for longer, higher for longer, and people just kept piling into bonds and things like that, saying that, oh well, basically saying that the Fed is bluffing and that they're going to pause and cut rates. Now it's been a very long time and we're getting much closer to the end of this cycle. If there's a possibility they may continue to raise rates, but most likely the higher probability is that they are done and they are officially paused. And the big question is, when are they going to start cutting rates? Right now, you want to keep in mind that typically, them cutting rates is around times where the economy does not look great. So, betting on, the Fed rate cut to be super bullish for stocks may not be the best scenario, and you may not want to wait to buy stocks until then, because as I mentioned, that could mean that things are very bad for the economy, and that could start to get reflected in the stock market. Now, there have been several prolonged periods of rising interest rates since 1990, and basically, why we're showing this is that, hey, listen, the bond market can go up, all right, or the stock market can go up during times when the Treasury market is going up, when Treasury yields are going up. If you take a look, basically all of the shaded areas indicate rising rate cycles, and you can see, there's been plenty of times since 1990 that we've been in a rising rate cycle. And, we've actually seen the market, green during those times and go up during those times as well. This is the risk reward and duration right now. This is from Katie Greenfield, and these are the 12-month expected returns for 30-year treasuries. If yields rise 50 basis points, it's down about 3% more. And then if it falls 50 basis points, you're looking at about a 13% gain. Okay, now this is via some data from Bloomberg. Okay, and you can screenshot this or whatever and take a look at the 2, 5, 10, 20, and 30-year treasuries, and take a look at those. But basically what she's saying is that the risk is very small compared to the reward. Okay, you're looking at about a 1 to 4, so risking 1 to potentially make 4 when it comes to your risk reward ratio for the 30-year treasuries specifically. Now, what we're looking at here is going to be the S&P 500 in basically 2000, so like your dot-com bubble, and then the S&P 500 in 2007, right before the great financial crisis. And then we have TLT in gray, and you can just see how extended this bear market has been, right? So you can see that the dot-com in blue, and then the great financial crisis in orange here, you can see we had the huge massive sell-off, and then we actually started to recover. And what we're looking at here, all right, is basically the amount of trading days. So the early 2000s peak to trough bear market was 637 trading days. The S&P 500.com bubble peak to trough was 355 trading days. And the current long-term treasuries peak to current bear market is 800 trading days. So it's just absolutely insane how long this bear market has been and how extended it's been, when it comes to bonds and things like TLT. And this chart right here really does a great job of, emphasizing and visualizing it for you. There's been lots of pain for years now, for years, literally for years, in things like TLT. And, everybody is just waiting and waiting and waiting for this thing to bottom. The big risk with that is catching a falling knife, right? And so, every time in the past, if you tried to buy these dips over the past couple of years, you've been catching a falling knife. So the big question now is, have we potentially bottomed, and, will we continue to see more downside in TLT? Now, this is KLXY. This is a luxury brand ETF. So it's got things like Gucci in there, Ferrari, Louis Vuitton. And I just wanted to bring this to you guys' attention, because a lot of these, brands that are going to be inside of this ETF, they sell, their consumer is going to be a different type of consumer than your Dollar General, for instance, right? Or your Walmart customer and things like that. So, this is one that I'm going to be paying attention to, diving into a little bit deeper into some of the holdings, how some of these holdings have performed in times of, economic uncertainty and recessions in a thriving economy. These are things that I want to pay attention to. And, if it fits my needs, or it fits your needs for a little bit of diversification in a portfolio, then that's the whole reason I'm bringing this ETF to your attention. Okay. Because it's luxury brands, and it's nice to see them kind of have their own little ETF and their own little sector now. And we can go and evaluate how it's performed in the past and see if it fits any of the needs for your portfolio, potentially as a sign of diversification. Now, these are the 12-month forward returns following the initial 12-month return, and year two returns typically positive regardless of year one magnitude. So essentially what we're saying here is that if we started a new bull market here, then next year, okay, the 12-month forward returns should be positive. Okay. There's I believe it's basically like 19 out of 22 times here is basically what we're looking at, where the stock market has been positive, year two of the bull market after year one. So if we get through this year and we're still in a bear market, and we don't enter into another bear market, or this wasn't or if this was not the biggest head fake ever and the biggest bear market rally ever, then most likely we're going to see positive returns next year. Now, next year is an election year, so that's another factor to consider. Election years don't typically bring the greatest returns in the stock market, and oftentimes that's because of a lot of uncertainty and policy, right? You have to remember who has the big money, and oftentimes those people are influenced and funding different politicians that are ultimately going to be helping their companies, and they're going to fund their side. And once the dust settles and clears, then you typically get a little bit of a rally towards the end of the year, regardless if it's Republican or Democrat that ends up winning. So just some good data here. A very high probability that if we continue this bull market that we're in, next year is going to be a positive year return for the stock market. And so this is some data right here from Fundstrat. So actually from Tom Lee. All right. And this is basically the plurality of clients bearish since 2021. All right. And, just kind of showing when everyone starts to get super bearish here, and you can see how it affects the stock market. And, you have the United Auto Workers strike right here. Most recently, we saw a very sharp pullback. And then we have the conflicts in the Middle East right now. And, that could be, we actually did just make new lows on here. Okay. This chart is a little bit old. It's about a week old. So you can see once we actually get into our analysis on the S&P 500, we did actually come down and create new lows already and broke through these lows right here. Now we have notable ongoing disconnect between the FMS macro view and US equities, right? And so the FMS is your fund manager survey. All right. And these two things, they typically, don't diverge that much. Okay. If you look, you see this huge divergence here right now. And then these things typically tend to snap back together, right? And you can see that they're more closely correlated with the, way that they move and how they track. And so if you see, we have the S&P 500 returns year over year looking very nice, right? That's the light blue line. And then you have the net percentage of fund managers expecting a stronger economy extremely low right here. Okay. And, so we're seeing this huge divergence, and one of these typically corrects itself. So either we're going to see S&P 500 returns start to drop very significantly, or, the net percentage of fund managers expecting a stronger economy could actually start to slightly tick up. Now, the source of the bull markets of 2024 is going to be private client cash and T-bills. All right. This is the percentage of assets under management. Okay. And, we can see here basically the very sharp rise in this. And, so if you don't understand what we mean by the source of bull markets 2024, this is a ton of cash. Okay. So if you look at the last time we saw this large amount of cash was in March of 2020. Now in October of 2023, we've seen the same amount. Okay. And what happened right around this time? This is when everybody was getting stimulus money. Okay. And then as this goes down, you're seeing that money leave cash and T-bills. Okay. So, this is basically money on the sidelines. So, there's a huge potential that if things, play out correctly, all right, that a lot of this massive amount of cash, this huge, large amount of cash, okay, 15%, is going to start going into equities, right, and going into stocks. You can see here that the average is around 13%, but that's including some extreme highs over here. Right. So, it most likely it will gravitate towards this 13%. But if things get extremely bullish, you're going to have a lot of people, taking this cash out, okay, and putting it into the markets, taking out their T-bills, taking out their cash and putting it into equities and stocks. Now, this is a good example of why you don't want to wait for the Fed. The market bottomed before Volcker shifted his tactics. The entire decline erased in 4 months. Okay, so you can see down 27% in 430 days, and then the S&P 500 in 4 months, the entire decline was erased completely. So, it's very tough to time these things. This is when Volcker suggested that they may shift the tactics, was basically halfway through, and the market had already went up 19% in 37 days. Okay, so you can see a very large rebound right here, prior to that. And then that's when you actually have, after he did that, that's when you actually got the rest of the entire decline erased, in that short period of time. Now, this is PMI recoveries, and PMIs look to be in the bottoming process here. We have ISM and S&P Global Manufacturing PMIs. I think in today's pre-market, we're actually getting some PMI numbers today. So we'll have to see how those turned out and played out as well. But just some simple concepts, right? I mean, here you start to see a decline. You see what looks to be, a topping process. Here we're starting to see what potentially could be a bottoming process. That's going to be good for the economy. We have S&P 500 bottoms 11 to 12 months before EPS bottoms. EPS is earnings per share. And so, what we're explaining here is that the stock market typically will bottom before earnings bottom. Okay. And what we mean by that is, the stock market is forward looking. So, if the stock market is expecting bad earnings for stocks over the next 6 to 12 months, right? It's going to start pricing that in. And after they've priced that in and done those price cuts reductions, now they're going to be looking at the next earnings reports and saying, hey, well, maybe actually a year from now it's not going to be as bad as we thought it was. And so you'll start to see the stocks start to recover and rise because investors are looking into the future. And then, they get to the point where, all right, well, then they hit that bottom in their earnings, and all of that was already priced in, right? And so a lot of people sometimes can get confused on, well, this company is not necessarily beating earnings. How come the stock is rallying? Well, oftentimes stocks will move off of the forward guidance rather than earnings, and if investors have already been preparing ahead of time for, lower earnings, then that's basically the thesis that backs up this data here, right? That the S&P 500 bottoms before the earnings per share bottom. So before earnings bottom. Now, this is forward and operating earnings, and we're seeing in a slight little uptick in here. Okay. So the forward earnings you can see here is actually inclining. And so if we talk about earnings bottom, the S&P bottoming before earnings bottoms, it appears that earnings are in the bottoming process. And we have a huge earnings week this week. We're going to see if these companies have potentially bottomed in their earnings, and things are going to start recovering and looking better for 2024. Now, bulls have been rewarded more than bears over the prior year. I mean, that's not really a huge surprise, right? We already had that, incredible bear market in 2022, and 2023 has been a strong recovery. We actually bottomed in the S&P, this month last year. And we can see that, tech, this is the S&P right here. Industrials really have been leading the way, communication services, and then you have discretionaries, materials, financials, energy, healthcare, real estate, staples and utilities have been getting absolutely crushed and reamed. And in my opinion, a big factor of that has been the rapid acceleration in treasury yields. Okay, as yields are going higher, that's going to make bonds more attractive, and oftentimes, investors looking into staples and utilities, oftentimes those can be, really dividend stocks, essentially, right? And a lot of people get into those for the dividend. And now, people can actually get risk-free, quote unquote, risk-free, as long as the government doesn't default on their debt. Oftentimes they can get a higher yield on treasuries than they could in staples and utilities, especially with the inverted yield curve and short-term duration treasuries and T-bills, right? I mean, if you can get a 3-month or 6-month or 1-year T-bill, and lock in 5% rates, why would you bother messing with a staple or a utility for a 3% dividend or a 4% dividend, and the stock is going to be extremely volatile, right? So that's kind of my opinion on staples and utilities. Now, there's a big theory here, okay, and this is from Tom Lee, basically the ultimate permabull. Basically talking about how technology will become 50% of the S&P 500's weighting in the future. And it's basically revolves around labor shortages, right? The outperformance of tech stocks during periods of labor shortage is substantial, and we believe the forecasted 2015 to 2047, labor shortage is going to benefit technology stocks. So, what we're looking at is the comparative relative performance of U.S. tech stocks during U.S. periods or during periods of U.S. labor shortages. And you can see here when tech tends to go parabolic and absolutely parabolic. And the whole theory behind this now is that, population is growing. Okay, so it's got some demographics behind it. And AI essentially is going to be the thing that solves the labor shortage. Okay. So, I'm not going to debate too much on this. I just kind of wanted to bring this to you guys. But essentially, if we are going to be experiencing this labor shortage into 2047, as some of this data suggests, a big factor that's going to make up for this labor shortage is going to be potentially AI making the labor that we do have more productive, and potentially even getting us to that point where, we've got robots. And I know that may sound a little crazy. We've already got robots, and the advancements they're making is crazy. They actually just made it to where there's been some recent advancements in robots, basically being trained by AI and using AI to train them, and that's going to keep accelerating and accelerating, and technology is just going to keep advancing at rates and a speed that we've never really seen before, and so I'm very excited to see how that progresses, but it's also a little bit scary. Now, the secular bull market has been reignited. We're looking at the normalized price performance of the secular bull markets. All right, and this is basically on a monthly chart, and the orange here is going to be our current, and so we're looking to see if we can continue the rest of this 20-year market, or bull market rather. And so we basically need to take out the new highs. Okay, that's the thing that to me that this chart is a little bit misinterpreting, is we need to take out the previous highs. Okay, that's a big factor, and that's something that the S&P 500 really needs to do, and then I'll feel a little bit more confident in the reigniting of the secular bull market. Okay, now is more chop needed? What we're taking a look here is the third year of a new president, aka pre-election year. Okay, in orange, and then you're looking at year 2023. That's right now, and so you can see we're continuing to head lower here. But if you look at the seasonality of pre-election years, we really do just continue to chop around and test the lows that we made in October, and then at the end of the year, we get this end of year rally, right? So we're gonna see if this plays out, right? If you take a look at October seasonality, the solid lines are your standard years in the market, and then the dotted lines are your pre-election years. And so what do you see in those pre-election years? What do you see where we're at right now? You typically start to see a pullback and then a recovery towards the very end of the month. Okay, so seasonality for October in pre-election years is corresponding pretty well. And if we take a look over here with the seasonality for the entire year, it's also playing out very well. And this is kind of the same thing. This is the last 10 pre-election years. Okay, and you can see again starting that bottoming process in late October here, and then we get a extended rally into the last 2 months of the year. This is my seasonality chart from Thinkorswim. And basically we have the current year right here, and then we have the seasonality down here on the bottom. And you can see it's been following pretty well, right? We're getting, we're supposed to have new highs here in the beginning of the year. We have new highs, then we get a pullback, then another pullback over here, another pullback over here, new highs, pullback, pullback, right? And you can see this is where the slight divergence is at the moment. Okay, is we are extending our pullback here, and we are going to see if we can put in this bottom sometime in October, and end up creating new highs, right? That's what that to me, this is what, if you're trying to play seasonality, this is what you're going to be looking for. Okay, is you're going to look to see, can the S&P 500 make new highs before the end of the year? So let's see if any of the technicals actually align with this. Now, this chart may look a little bit messy to you, but I've basically highlighted the important parts for you guys, right? So take a look at the trend. Lower highs, lower highs, lower highs, okay? And this has happened since basically July, all right? So we're continuing to make lower highs, and we're continuing to make lower lows here as well, just making a new low after finding some support right around that 4,200 area. Okay, so the big question now is, are we getting a bounce to come down lower and test the next area of support right around 4,100? Now, the market does like round numbers, so we may see some support in here right around 4,150. Okay, 4,175 below this 4,200. But ultimately, I think if we stay below 4,200, we're going to come down right around to this 4,100 area potentially, right? That's the bearish scenario where we continue to make lower lows and lower highs. Now, if we can extend this rally, okay, and it's not much of a rally, but we do have a doji reversal candlestick, and the market's opening up higher today. If we can get above 42.68, all right, and ultimately we need to break out and make new highs, and so we need to fill this 4,400 gap. If we can come up here to 44.05, right around this 44.05 area, that's when we have the potential to actually break out of this downtrend and start a new uptrend. And then we have another gap up here right around the 45.60 area, where we would look for a gap fill there. Okay, so That's the big question right now is, are we going to continue staying in this downtrend, creating lower lows, creating lower highs, or can we finally start to get a rally and start to create some new highs? We're pretty far away from making new highs and breaking that downtrend right now. So there's a lot of work to be done, roughly about 200 points worth on the SPX. So, that's the big thing you want to pay attention to right now. The MACD crossing over right here, this white line crossing below the red, is not a great signal, but it's just in the very beginning stages of the crossing over. So if this can actually flatten back out and go back positive and get above zero, that would be a more bullish sign, a more bullish context. We do have some bullish divergence helping fuel the rally today, or the rally this morning, right? Take a look. We have lows here. And then we have new lower lows, right? So these are the lower lows that I'm speaking of. And we have lows and we have higher lows, right? So we are seeing some bullish divergence. We're going to see if that bullish divergence can potentially fuel the rally up higher in the S&P 500 and break us out of this downtrend. Now, this is TLT right here. This is a weekly chart. So, basically for TLT, over the last year, I've been saying it's very possible TLT could come down to the 87 area. We've, fallen much lower than that, and we're actually approaching the wave 5 targets of about $80. Now, I've mentioned 82 is going to be, an area, right? 82, 80, 78. We can't exactly predict the future and know exactly where things are going to go. But, using some Elliott wave, we can give ourselves a little bit of a guideline. Now, 82.05 was a big support level. We came down to that $82 area recently here on TLT, and we started to rebound and recover since then. Right. So it's very possible that we are actually approaching the bottom if we haven't already put in a bottom. But the big thing that I want to remind you guys of is, you're not going to get famous for timing the bottom. Okay. Your friends aren't going to care if you bought TLT right at the bottom. You're not going to get famous for it. Nobody's really going to care. So don't try and time the bottom. I mean, you can wait and you can look to see if something is going to actually form a bottom, right? If you keep trying to time the bottom, right, and you come here, you buy this bottom, you buy this bottom, you buy this bottom, you buy this bottom, you bought this bottom, you know, you're underwater still at this moment. Okay, so I just want to give a little bit of context and, just remind you guys, right? There's nothing really pressuring you guys to go all in and, have to time the bottom, right? You can come up with a plan. You can try to dollar cost average. You can choose price levels that you want to get in and out of at, right? So maybe you wanted to get in at 82 and you want to get in at 80 and 78. And then, if it drops below down to 76 or something, maybe you cut, just however you guys want to come up with your own strategies. That's on you, but try to have a plan coming into these things, right? Don't try and time the bottom by going all in on TMF weekly call options, and just going full portfolio, and potentially blowing up your account, right? That's all I want to say basically, and just remind you guys of is be careful of that. Okay, you don't have to do those things. And you're not going to get any brownie points or anything like that. If you tell your friends about it, they're going to say, what is the bond market? What's TLT? And if you do time the bottom, and you get it right, I mean, you're going to make some money, but you're not going to get any special awards, right? None of us are Bill Ackman. We're not going to make the cover of CNBC just because we're timing the bottom and timing the top on these things. Now, this is the daily chart zoomed in a little bit more. We've got some bullish divergence here helping fuel the rally. Okay, all these blue boxes here are gaps up. TLT's daily chart is literally just scattered with gaps all the way up to 100, right? So, if we can get this potential short squeeze and see, tons of institutions, closing their short positions in U.S. Treasuries, then it's very possible we could start to get some of these gap fills. But really, ultimately, to me, below $89, it's all just chop territory, and we could potentially continue to head lower. Now, this is where we would like to see it consolidate and actually form this bottom, right? If we can see it consolidate within these ranges, okay, that's going to be a good sign. All right. And then ultimately, we want to get back above $89 and start the reversal process and look to see if we potentially put in our bottom for TLT. So, I mean, no matter how you draw it, you draw a downtrend line here. We're still in a downtrend. We haven't really broken. You can draw a trend line here. You can draw a trend line like this. However you want to draw the slope of your trend line, it's in a downtrend no matter what, no matter which way you look at it. Okay, so keep that in mind. Not only do we have this shorter term bullish divergence, but take a look here where we have lows, we have lower lows. So we have a very extended and drawn out bullish divergence where we had lows and there was slightly higher lows here on the RSI as well. So lots of technical reasons for us to be seeing a bounce in TLT. We'll see if that bounce can continue, if we can rally and fill some of these shorter term gaps up here. But ultimately, $89 is that level that we want to pay attention to. All right, if we stay below there, then perhaps we're just consolidating here, trying to form that bottom, trying to do that bottoming process. And if we break below $82, we have $81.37 and $80.26. Those are going to be your support levels below $82. Okay, but anything under 89 to me is just going to be potential chop. So I'm just still watching here for now. The big thing to remember about TLT is that the US is flooding the Treasury market. Okay, that's been one of the main factors that we've seen bonds continue to sell off, is because the US has, basically flooded the Treasury market with almost $2 trillion worth of Treasuries. The Fed is doing quantitative tightening, the exact opposite of quantitative easing. So, who's actually coming in and buying $1.76 trillion worth of US Treasuries, right? I mean, it's not me, it's not you. So unless, people like Bill Ackman, Jamie Dimon are coming in with these, huge institutions like BlackRock, Vanguard, State Street, and all these people, if they're coming in and buying up some of these treasuries, you have to ask yourself the simple question, at the end of the day, these markets move based off of supply and demand. Okay, supply zones, demand zones, different things like that. And is there more supply for US Treasuries than there is demand? And if there is, then we're going to continue to see them fall. And if if we're going to continue seeing the Treasury market continue to get flooded with US Treasuries, and there's not enough demand, we're going to continue to see it fall, right? For years now, the Fed has done quantitative easing and been buying up US Treasuries, and now that they're not doing that, you can see it's really impacted the bond market. We showed you guys in the beginning how this was, basically the worst bear market that the bond market has ever really seen. Right now, this is TNX. This is your 10-year Treasury. A lot of people are going to be paying attention to this when it comes to taking a look at Treasury yields. And you can see, it's trading very systematically in these channels, and these buying algorithms is what it looks like. And we came here, we've topped out previously, and we're topping out again, at the top of this channel below 4.894 on the TNX. I think we can continue to head lower. There's two gaps down to fill. And, if you're bullish on TLT for the short term, or the long term, you want to see these gaps fill, right? There's a gap down to about 4.715, and then another gap here just below 4.4. Okay. Those are where you want to see. Now, the big thing you need to be cautious of is, is that just going to be a wave 4 pullback, right? So, after we got a corrective ABC that came down here, potentially this is our wave 3 up here, right? And we're topping out wave 5 of wave 3 here. Let me fix this drawing tool real quick, get you guys something a little bit better, right? So 1, 2, 3. Okay, and then wave 4 would be the pullback around these gap fills. So even if we do come down and come to these levels, even down to 4.4, the big thing we need to be cautious of is these things turning back up around and hitting wave 5 highs, which would actually be above 5% on the 10-year Treasury. I've got those going from anywhere at 5.04 to 5.12 to 5.41 to 5.56. Right now, we're pretty far away from there. There's a lot of work to be done to reach those targets. We had some bearish divergence here. So, creating higher highs and then creating lower highs on the RSI, basically the exact opposite of the bullish divergence that we saw on TLT. So there is a little bit of technicals fueling this drop here in Treasury yields and the rise in the bond market. Again, rejecting the top of the channel, bearish divergence, starting to see that pullback. Can we get the gap fill soon at 4.714? And if we can break 4.715, can we get, the gap fill right around 4.4 on the TNX? If we can, that's really going to boost things like TLT and really help them out. All right, now that's it for today's video. Hopefully you guys enjoyed it. If you did, smash that like button, subscribe to the channel. Don't forget to sign up for the newsletter. Link is in the description for that. Don't forget to check out the Ko-Fi page if you guys ever want to do some one-on-one personal sessions with me. And I actually just launched the investment intelligence Discord. So if you guys want to join the Discord, the link is going to be in the description as well to join the Discord and get access to all of the different trade ideas, not just the couple free ones from the newsletter, as well as many other valuable resources and a nice little community of other traders.